Okay, I see you on there.
Okay. Hi, thanks a lot, Sean, for the introduction. Hi, good morning, everyone. Thank you so much for taking time off from your Saturday morning to listen in to this fantastic webinar organized by FSMOne. Yeah. For my session today, what I want to do is I want to share my experience on how do you digest information that we get every day in today's digital world, and how to make use of this information for us to have a sense where market is going to head, be it for equity or for the fixed income side, right? So what I propose is that we really need to simplify and categorize the information that we read and how it's going to affect the three categories. In this case, how it affects profits of the companies listed on the Bursa, how it affects the bond yields, right? The second category is how it affects liquidity. Liquidity in this case means investment money, where investment money is going to flow to. And of course, the third one is how it affects valuation, right? So we need to understand the interaction between all these three categories because it's very complex. But unfortunately, we do not have time to really understand the interaction. So we just stick to the simple part of how this information will affect all these three categories. Yeah? Now, the first part that we're going to talk about is how profits going to affect the movement of markets, in this case, the stock market. And second thing is how information can affect bond yields, which in turn affects the bond prices. Okay. Now, if you look at this chart here, the black line is basically the KLCI index, which everyone is familiar with. And the red line is the profits of the companies listed or constituents of the KLCI index. Right? Now, what I'm trying to show you is that profits is very important because when profit goes up, you see the stock market goes up, right? And when profit comes down, the market comes down, right? And you see the same pattern repeating by itself. And this year, we expect profits to go up by a lot, mostly because last year was a very bad year due to COVID. Okay. And this same trend, you see it all over the world. If you look at the chart on your top left, right, you see the Dow Jones. Right? When profit goes up, the Dow Jones goes up. When profit comes down, Dow Jones comes down. Right? You see it for Asia Pacific ex Japan. You see it for the Hang Seng Index, and you see it for the Japan Nikkei. Okay. Now, so what we will need to do is we're going to make things very simple, right? We're going to look through what are some of the macro factors that could affect the profitability of companies as well as bond yields. Right? This slide over here is something that I took from the internet just to get a sense of what are the key factors that could affect the short-term economic growth. Right? The 6 factors listed here, of course, is the interest rates set by the central bank, right? Fiscal policy, commodity prices. Commodity prices is very important to Malaysia because Malaysia is a major exporter of commodity. Then exchange rates. I'm sure those of you who have children studying overseas would understand why exchange rates are very important, right? Trading conditions, as well as business and households' confidence. Right? Now, the first 2 factors, interest rates as well as fiscal policy, I'm sure you have read news about what are the weapons that the government has in terms of trying to boost the economy. One is called monetary policy. The second one is fiscal policy. So we start off with monetary policy, right? Now, if you look at the chart on your right-hand side, this is something called an overnight policy rate. Overnight policy rate is the rate that Bank Negara determines what banks can lend to each other over one night. Those are the extra money that goes into the bank at night. Right? Now, This rate is very important because it sets the direction of where interest rates is going to go in Malaysia. Now, if you look at this chart, it's over the last 20 years, the high was about 3.5%, right? On average, it's probably about 3 to 3.5%, right? Currently, if you look over here, it's about 1.75%. It's really all-time low in Malaysia. Okay. Now, when OPR is all-time low at 1.75%, basically what it means is that the lending rate in Malaysia is also at an all-time low. Okay. When lending rate is all-time low, basically the interest charges that companies have to pay is much lower. The housing repayment that we have to pay is also much lower. Now, this is very positive because when we pay or companies pay lower interest rates, the profits goes up. Okay. Now, the second thing is bond yields, right? If you look at, this is the bond yields of the Malaysia as well as the US 10-year government bond, right? And if you look at the fine line on your right-hand side, that's the start of 2021, right? And you see from the start of 2021, you see that bond yields have actually started to go up, right? Part of the reason is because a lot of people expect that US recovery is coming. And because of that, interest rates is going to go up. But we believe as a house that thought is probably a premature because although recovery is coming, but the recovery is unlikely to be as strong as what the market is saying. Okay. Now, but this is a good thing because it basically means that when you buy into bonds today, the return that you get from the bonds is actually higher. Now, the second macro factor that we talk about will be fiscal stimulus. If you look at this chart here, this chart basically shows you what our government has actually announced in order to push the economy following COVID last year, right? The government has actually announced a total budget of about 322 billion, right? Or 24% of the 2020 GDP in order to help push the economy. Okay. This is very important. But one thing that you need to know is that the bulk of this 322 million is really money from you and I, because part of it constitutes money that the government allows us to take out from EPF, as well as delay the loan repayment, especially last year, right? So actual government spending is probably about 69.9 billion, right? That's about 5.3%. That's still a very good number. And it basically underscores that the government realizes they need to come in and pump prime the economy. So that's a very good thing, right? And this is not something that Malaysia is doing alone. Governments all over the world is doing something similar where they are going to pump prime the economy, right? So as a result of this, I think in general, most people are expecting our economy to grow by between 5 to 5.5% in terms of the average economies in Malaysia, right? So that's a very positive news, right? The third macro factor that we are going to talk about is exports of commodities, right? We all know that Malaysia exports a lot, right? And export makes a big part of the GDP for Malaysia, right? One of the major exports that we have is crude oil, right? Crude oil is very important to Malaysia because crude oil in 2019, right, constitute about 50 billion ringgit to the government's revenue, or about 21.7% of the government's revenue. Right? In 2020, crude oil-related revenue rose all the way to 80 billion. Of course, if those of you remember last year, Petronas paid off about extra special dividend close to 30 billion in order to boost this up. Right? So for this year, if you look at this chart, crude oil prices have gone up a lot since 2020. right? And this is very positive because basically it means that the revenue that the government can get from crude oil is going to be a lot higher than last year. So to give you an example, the crude oil price last year on average was about $43, right? The average of crude oil currently is close to $62. Right? So you can see such a massive increase compared to last year. A most positive thing is that when I mentioned the expected revenue for this year from crude oil related, for the government's revenue is roughly about 38 billion, right? That is based on an oil price of about $42, right? Now, assuming the average is achieved at $62 US dollars per barrel, right? This is going to add at least 6 billion ringgit to the government's revenue. So that's a massive increase compared to the government's budget. Okay. Another major export of from Malaysia is basically the palm oil. Right? Palm oil again is very important, not only for the planters, corporations, it's also very important to the Felda settlers as well as the smaller stakeholders in palm oil. And again, palm oil has also gone up a lot, right? If you look at this chart, currently palm oil is about, the chart here says 3,800, right? But currently the palm oil price is 4,100, right? Again, this is a massive increase from last year. The last year average palm oil price was roughly about 2,700. This year, the average so far is already 3,700, 37% increase. What is more important is the cost of production for palm oil currently ranges between 1,600 to 1,900 per ton. So you can imagine how much money the planters are making. So all these things that we spoke about earlier, right, in terms of the macro factors, it's very important for one single thing, private consumption. Okay. Private consumption is basically the amount of money that you and I spend on a daily basis. And this is very important because private consumption in Malaysia accounts for nearly 60% of our GDP. Okay. So if we spend more money, for example, we buy more houses, buy more cars, go out dining more, buy more clothes, right? This will then help us to push our GDP further up. Right? Now, if you look at this chart over here, you see that there's a massive decline in terms of our private consumption in the second quarter of 2020. So some of you may remember the COVID came to Malaysia after Chinese New Year. And that's when we started to have our MCO sometime in, I think, towards the end of March. So which is why you see this massive drop in consumption, right? It rebounded then when it was lifted. But then towards the fourth quarter, things came back down and private consumptions came back down again, right? But I suspect for this year, if we are able to solve the COVID issue, I think we're going to see a bit of a rebound in terms of private consumption. One savings grace for Malaysia at the moment is how quick companies in Malaysia has adopted to online sales. So a lot of companies have quickly just moved their model from a physical retail to online sales, right? And online sales have grown very fast. For example, I think last year, online sales is anticipated to grow by 25% in Malaysia. And I think that this has helped somewhat to reduce or mitigate the impact of the declining retail sales in Malaysia. Okay. So after all these factors that we spoke about, right, then you get a sense that, in general, it seems like it's going to be positive for companies' earnings. Right? And this chart over here basically shows you what the market or the consensus is expecting in terms of earnings growth in 2021. Right? The red bar, it shows you the KLCI earnings growth, right? And the KLCI earnings growth is very good. It's expected to grow by 53% this year, right? 53% sounds good. But if you look at all the other bars, right, other countries are growing at more than 100%, mostly because they were badly affected by the MCO compared to us. So the base effect means that their earnings growth is a lot stronger than Malaysia. But nonetheless, 53% is still a very strong number. Okay. On the fixed income side, right, we have seen that yield has actually gone up, right? Now, this chart here basically shows you real yield. Okay, real yield is defined as, in this case, we use the 10-year government bond yield minus inflation. Now, if what we've seen here, if you look at the bottom line, the orange line, that is the US 10-year government bond yield minus the inflation. And you see that the real yield is negative. So in other words, if you buy into a US bond today, right, you don't hedge against inflation. In fact, you are losing money. Whereas if you buy into all the yields in ASEAN, in Asian countries, Indonesia, Malaysia is the black line, which shows you that we have a real yield of about 3.4%, right? So what this chart basically says is that generally you are better off buying bonds in Malaysia than buy bonds in US. So this is good in terms of asset allocation or in terms of fund flows, which we will talk about later on. Now, the second category that we talk about is liquidity. Liquidity basically means the flow of investment money from either from country to countries, from different asset classes. So, money could flow for many reasons. One reason could be money can flow from people borrow from a low interest rates country, and then they go and invest it in a high interest rates country. People call that a carry trade, right? Or you can flow from, say, people who invest in commodities, right? Now they go and invest in cryptocurrency, right? So, those are what we call liquidity flow. Now, you sometimes see this in the newspaper, or if you read brokers' report, especially brokers' report, this thing comes up quite often. This table here shows you the foreign funds that are selling down, in this case, selected markets in Asia. Okay. Now, if you look at the last two columns on this table, it basically shows you the foreign funds buying or selling in Malaysia. If you look at the second last column, that is the selling in US dollars, right? And you see that foreigners have been selling Malaysia stock market since 2018, right? Last year was particularly bad. They sold almost 5.8 billion US dollars out of Malaysia, right? This year, they have probably sold roughly about 429 million US dollars, right? These are massive amount of money that they have been selling. This chart basically shows you the foreign shareholdings in Malaysia, right? The current foreign shareholdings in Malaysia probably now is, this is end of February, is about 20.4. I suspect by now, because they sold at least another 300 million ringgit in April, that number would probably have dropped to about 20% currently, right? The good thing is that although the foreigners have been selling our stock market hasn't been doing too badly. The KLCI has now been showing a slight negative return so far, right? Despite all this foreign selling. But if you look at the broader markets, we're actually seeing a very good positive return, especially if you look at the small cap index. Small cap index year to date is up about close to 9%. Right? The reason is because retail investors are coming into the market. Okay, retail investors are basically people like you and I, and we see very strong retail participation. If you look at the chart on your left-hand side, right, you see that retail participation has been going up. Okay. What I particularly quite glad is that for the month of April, I don't have the chart to show you here. We have started to see domestic investors started to buy the market, right? Domestic investors since the beginning of the year, in line with foreign investors, have been selling the market. But for April, we see that has stopped and they are now starting to buy. So hopefully, if the foreign buying comes back in and our domestic investors are buying and supported by retail investors, then I think the equity market is going to do quite well for this year. Okay. So I think we have seen this chart earlier that we expect that 53% year on year for this KLCI to recover this year. Okay. For the bond side, demand continues to remain very strong, right? If you look at the chart on your left-hand side, right, this basically shows you the amount of government bonds that is out for sale in the market for this year to date, right? The demand has been very strong. It's about 2.1 times. Basically, what it means is that every time if the government issue 1 billion bonds, right, easily 2.1 billion worth of demand comes in for those bonds. So again, this is a very positive effect. Okay. And that demand not only comes in from domestic. You can see from this table here, the chart on your left-hand side, foreign ownership. NRA here stands for non-resident, all right? Foreign ownership has continued to grow since 2020. So again, this is very positive. And part of the reason is like what we explained earlier. Your return from US bonds is a lot lower than your return from Malaysian bonds. Another thing is, again, this chart is quite interesting. If you look at the chart or the table on your left-hand side, right, this part here, right, this is the impact of currency in Asia against US dollars, right? And you see that countries like Japanese yen, Thai baht, Malaysia ringgit, and so forth have been negative or weakened against the US dollars. Right? Now, if you look at this table here on the right, right, this is a consensus forecast or survey on economies on how the currencies are doing. Almost all in fact, all currencies is expected to strengthen against the US dollars, with ringgit expected to strengthen by 2.8% by end of the year. Okay. So this is basically positive in the sense that money could flow into the region if you expect the US dollars to weaken. Now, the third category is about valuation. Okay. Now, valuation for stock market, in most cases, you hear people talk about PE, which is price earnings. For those of you who are not familiar what a price earnings is, price earnings means the number of times that you pay for the profits of a company that you buy. Okay. For example, if the company makes 1 ringgit and you pay 10 ringgit for the company, your PE is 10 times, right? So that's what the PE ratio is. Okay. Another way to look at it is 10 times PE is also equal to a yield of 10%. So in other words, you will actually recoup your earnings in 10 years. Okay. Now, this chart here is very interesting in that for valuation, when we look at valuation, in most cases, valuation is not very important until it turns excessive, whether it's on the upside or on the downside. Okay. Now, this part here is going to be a little bit technical, so bear with me, right? The red line here is the price earnings ratio of the FBM AMAS index in Malaysia. Okay. So what I've done is that for those of you who still remember your statistics, I have done a regression or a best fit line, okay, over the last 10 years from 2011 until now, right? And what I've done here is the red line is the mean, okay? The gray line here is 1 standard deviation, and the green line is 2 standard deviation. Okay. Now, you pay particular attention when the PE line goes to 1 or 2 standard deviation, especially 2 standard deviation, because basically it means that chances of that happening is very rare. Okay. Now, you see that each time the PE drops below 2 standard deviation, what happens to the FBM mass index? There's a rebound, right? You see it over here. If you can see my cursor, right? You see it here, below 2 standard deviation, and the market bounce back. Again here, and the market bounce back. Over here again, right? And a massive bounce back. Now, so if you look through the current PE of the FBM mass, right, it's actually cheap because it's 1 standard deviation below its mean. Okay. Now, the same pattern you actually see. Earlier, we saw that for our mass, it goes to 2 standard deviation. But some other markets, they don't go to 2 standard deviation, but 1 standard deviation is actually good enough. So in this one, this is the MSCI Asia Pacific ex Japan Index. Again, you see the red line, which is the PE. It touches 2 standard deviation, the index is going to bounce, right? So you see it many times. Here it almost touch 2 standard deviation, the index bounce. It comes back down, right? And then almost to 1 standard deviation, it bounces again, right? Of course, here it drops all the way 1 standard deviation, 2 standard deviation, and then you see a quick rebound from the market. Do you see the pattern, right? So again, this helps you, helps the fund managers to have a sense when earnings are excessive. When these are very low, it basically shows us maybe it's a very good opportunity to buy the market, right? Of course, it's the other way when, let's say, the PE goes 2 standard deviation above mean, okay, maybe the market has become excessive. We should consider, has the market becomes too excessive? So these are basically points for us to consider. Because when market goes above here, right, what it means is that the market thinks that the earnings is going to be very strong, right? So for the market to go up even further, the real earnings have to be stronger than what the market is expecting. So sometimes when the real earnings comes in below what the market is expecting, then you see a disappointment, which is why that's when you see index coming down. Okay. So these are the same pattern that you see for other markets like Hang Seng, Shanghai, Thailand, Jakarta, and so forth, right? Okay. Now, for the domestic bond market, we find that we also see some values, right? Earlier, you saw the chart that I showed you. The government 10 years bond yield has actually been going up since the beginning of the year. Okay. This chart here shows you the yield curve of our Malaysia sovereign bond yield, right? And you can see very clearly that the yield has been going up a lot compared to 3, 6, and 9 months ago. Okay, so effectively it shows you that the yield that you're getting from the local bonds are higher than, say, 9 months ago, number one. Number two, if we believe that the yield has actually moved ahead of the real fundamentals, then we think that it's a good time to buy the government bond yields as well. Okay. Now, so we have gone through all the 3 things, right? how news that we read affects profits or bond yields, how it affects liquidity, and how it affects valuation, right? So the key thing is that how do we put all these things together, right? So what I propose is for retail investors, for like yourself, right? One way you can do it is you do a simple scoring system, right? What I would propose is maybe you put in, let's say that if we look at the table on your left, right, scoring for equities market, say things that affect profits, growth, right? So government fiscal spending, interest rates, unemployment rate, and so forth. Then we do a simple scoring, 1 to 5. We do a simple scoring 1 to 5, right? And after do all this scoring for all these three factors, you would be able to tell uh, whether you think the market is going to go up or go down, right? And you can do the same thing for the fixed income cycle, right? So by doing this, you have a good sense of where you want to do your asset allocation, right? And so just quickly, I just want to end. For those of you who do this and want to do your own asset allocation, right? ETF is actually a very good way for you to do asset allocation because number one, I think like some of the other speakers have mentioned, it's very cheap and it's very easy, and you don't have to bother about what are the underlying investments in the ETF. All you need to know is that if you think that the market is going to go up, you just buy the ETF for equities. If you think that the bond market is going to be good, then you just buy the bond market ETF. Okay. And lastly, I'm expected to put this disclaimer for everyone to have a look at. Right? Okay. I think that's all from me today. Thank you. Back to you, Sean.